Hello everyone and welcome back to the channel. This is Fair Value Finder and today we're taking a look at the Microsoft earnings. Now this is a stock that we've looked at previously and we know that it is a really good company, and the price to invest probably around 270 on the higher end would not be a bad place to get in, even up to the 300s. So we're going to read through the press release and look over the numbers to see the good and the bad. On the lower end, we're looking for double-digit growth. 12% really is the lower part of what we've seen. So 12% is what we're really looking for revenue growth. Earnings growth would be nice to see around 10% year-over-year growth, and we'll continue on from there and see where everything comes in at, because as long as they can stick with what they've done previously, they are an incredible stock to hold with market-beating returns going into the future. So to start, revenue increased by 13%. Very good, right in line with what we expect. 12% on constant currency, that's fine. Operating income increased 25%. Net income increased 27%. Earnings per share increased 27%. So even stronger than we're really looking for. And so that's going to be pretty good for the stock. Definitely raise that fair value. They talk about AI and how it's going to help businesses everywhere. The AI hype has died down a little bit, but what Microsoft is doing is really cool. What Google is doing is really cool. And they're probably going to be the ones to really push and see the benefit of a lot of this AI stuff. They're rapidly infusing AI across every layer of the tech stack and every role in business process to drive productivity gains to customers. So for their business highlights, we talked about the 13% increase. Saw commercial products and cloud service revenue increase 15%, driven by 365 commercial, up 18%. LinkedIn revenue increased by 8%. That's right. I didn't know this previously, but LinkedIn is owned by Microsoft. And Dynamics products revenue increased 22%, which again is a really good service that Microsoft offers. Cloud revenue increased 19%. Server product and cloud services increased 21%. All of this looks incredible. Windows revenue increased 5%. Xbox content and services increased 13%, but devices revenue did decrease by 22%. So that is a pretty big drop there on devices. That would be like the Microsoft tablets and potentially even their phones. Search and news advertising revenue costs increased 10%. So here they detail everything that could affect their business, and it's typical stuff: competition, not all acquisitions will turn out as expected, cyber attacks. There is a lot. The larger you become, the more risk you open yourself up to. So catastrophic events such as COVID-19. That brings us over to the numbers. They like to use their own products for these. Their statements were in a Word document on their site, and the numbers are in an Excel document, which kind of makes it easy because we can actually do the math and everything here, and it's something I'm familiar with. So what we're looking at here, revenue increase of 12.8%. So right about that 13 that they had talked about, from 50 to 56.5. Cost of revenue increased by 5.5. So not only are they bringing in more revenue, but it looks like their margins are even getting better, with a jump of 6,000 in the revenue. They saw a jump of not even 1,000 in the cost of the revenue. Gross margin jumped 16%. R&D, they are investing a little bit more, essentially in line. Same with sales and marketing. General administrative did rise a bit, 5.4%. So operating income up 25%. Other income up 620%. So there is something interesting in here. I was looking through the numbers. We'd have to really get down to the nitty-gritty to see what's going on with this. It looks like the sale of something. EBIT up 26.5% to 27.2, up from the 21.5 that they saw last year. I mean, everything here is insane. In double digits, a lot of it in the 20s and 30s, which is just incredible. Net income up 27%, EPS up 27%, shares outstanding down almost 0.5%, and everything is trending in the direction that we'd like to see. Assets up 8.21%, large jump in their cash and cash equivalents. Again, probably related to over here, they saw that huge jump in other income. It looks like a sale could have definitely brought in all of that cash and really bumped that up on their balance sheet. Short-term investments down 17%. Not the worst thing, especially with how the stock market's been performing, but it could be tied to the fact that investments are underperforming. Down 17% would be quite a bit of an underperformance, though. Accounts receivable will fluctuate. Inventories are up 20%. Other current assets up 8.6%. Total current assets up 12.6%. Other thing to note, equity investment up 15.63%. So they got a pretty good boost there for equity. For liabilities, the things to note, a lot of drops here. Long-term debt down 28.57%. Accrued compensation 36.5%. Short-term income tax jumped, almost doubled. Short-term unearned revenue is down a tad, and other current liabilities are down just a bit. Overall, the total current liabilities are up 19.82%, mostly driven by that short-term taxes. As you see, a lot of the others are down. Long-term debt down a tad. Long-term income tax down. Long-term unearned revenue is down. Deferred income taxes is up 8.5%. Operating lease liabilities up almost 6%, and other long-term liabilities up 3.63%. So in total, liabilities are up 9.39%. The pace of growth is faster than the assets, but the actual dollar value is nowhere close. This is up 20,000, while the revenues are up 34,000. Shareholders' equity. Total shareholders' equity is 220,714. These are all in millions. And that is growth of 7%, which is very good. Essentially, that means that their balance sheet got 7% better in the favor of shareholders. And then we have cash flows. So for cash flows, at the end of the day, they came in with a huge influx of cash, 45.7 compared to the almost 9 that they had last year, leaving them with that large mountain of cash at the end of the year. So we can now see what exactly is going on with all that cash. Where is it coming from? Because they saw a huge jump. And we can now determine exactly where that jump is coming from. So 26% jump in net income. That's a pretty big bump. Net recognized losses or gains on investments. It was negative last year, positive this year. Deferred income taxes at about 50% less than it was last year. So in total, cash flow from operations was up almost 32%, driven a lot by that net income. As you can see, that's the largest number here and one of the largest percent jumps. And then the depreciation and the stock-based comp expense were also pretty big movers here. Financing. Last year, they were using a lot of cash for financing. This year, they were making a lot of cash off financing. So they might have made good investments. See, proceeds from issuance of debt maturities of 90 days or less. They did not issue any last year. This year, they issued 18,692, which also brought in 7,000 in proceeds from the issuance of the debt. All in all, not as large of moves here. We do see things like a 19% jump in common stock issued, and we do see that the dividends grew a little bit, and they did repurchase a bit less. So all in all, this financing portion was driven by the issuance of debt maturities. So they're selling corporate bonds. And then investing. Additions to property and equipment. They seem to have purchased a lot of property and equipment. Acquisition of companies. They acquired more or spent more on those acquisitions. Purchases of investments. They spent more on investments. The maturity of investments. They made a lot more money this year than they did last year on the maturity of those investments. And on the sale, they made about twice as much as last year. So that all comes down to net cash from investing. Last year was a loss of 3,132. This year was a gain of 503. So all of that adds up to a huge cash flow, 45,748 compared to the almost 9,000 of last year, about 4 times as large, giving them a huge cash position to end out the quarter. And so with all of this, what's all of it mean? Everything is trending the right way. I really don't see any issues with anything that we're seeing here. In fact, we see more positives than we were even expecting. So that could boost up that fair value of the stock to 300s would definitely be a pretty good price, and we'll truly reevaluate at the end of the year once we have the full year's numbers and the guidance for next year. So I want to thank you guys for watching. Please like if you enjoyed the video, comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.